Hi, everyone. Welcome to another edition of Spilling the Tea on GovCon. I'm Teresa Moon, Vice President of Communications and Marketing for Parabolis. We are the preeminent partnership for government contractors, providing holistic support that includes a line of credit to fund your growth. The purpose of this podcast is to assist small businesses with success in the federal marketplace by introducing them to industry experts and resources that they may not otherwise know about. Today, we welcome John Barnes from Pendleton Street Business Advisors. We value insights from firms like this and are proud to spotlight his expertise on this show. Welcome, John.
Thanks, Teresa. I'm happy to be here.
Absolutely. And I know I've done a little bit of work with some of your colleagues, and so I was excited for the opportunity to get to chat with you, learn a bit about what you guys do and how what you do can be applied to the business owners that are going to be listening to us today.
Sure.
We, in preparation for this conversation, we're looking at it as your business as your largest asset. And I thought that was really indicative of some of the questions that I'm going to be asking you. So I'm excited about it. And, to start off, you founded Pendleton Street Business Advisors over 10 years ago. And in the beginning of things, when you were first getting involved in your own business, what gap did you see in how business owners were approaching their finances?
Yeah, that's a good question. I think that the gap was that most business owners don't see themselves as like the lead investor in their own business. In other words, a lot of business owners found their business to basically give themselves a job, and then leading a large employer in a similar industry. They want to do it on their own, have more time freedom, earning potential, things like that. But because they were in employee mode from the old thing, they sort of remain in employee mode in their thing. And so that's probably one gap. The second gap is that everyone needs a financial advisor. I'm a big believer in that. Most business owners, they do not need a financial advisor because if they get in a financial jam, they just go to the cookie jar. They can take money out of their business. They started their business for increased financial security. And I get all that. I'm a business owner too. I may have done that a time or two myself over the years. But they also think that financial advisors are just about stocks, bonds, mutual funds, life insurance. And those are things that a lot of them, I would say the vast majority of financial advisors focus on those kind of things. I wanted to set up a firm that spoke to the heart of business owners' financial needs, which was if their business is their largest investment, and it is in most cases, how does that need to grow? How does that need to operate for the business? But how does it need to operate for them as a person? For themselves, for their family. That's the financial engine for for their life. It's got to do something on the business side, and it's also got to do something on the personal side. So let's try to marry sort of the principles that a certified financial planner would bring in their role with a CFO.
Mm-hmm.
So you get the finance aspects of the business, and then you get the personal financial planning that they usually have to find elsewhere. But again, 9 out of 10 financial advisors do not advise on illiquid assets or on businesses.
Right. I love the way that you started it by talking about your own personal experience of being a business owner. And so I think you're bringing a level of unification there between you and your clients and potential clients by talking about it in that approach. On our side of things, we talk about it a lot and how it relates to us as those that are opening up their businesses, just like you said, coming from a background of potentially having worked with someone else, performing that capability or being within that industry, and then branching out knowing that the benefit to them would be to start putting money in their own bank account as opposed to earning the money that goes into someone else's. And so what happens is those business owners are essentially functional operators as opposed to real understanding of the business acumen that's necessary to operate and run your business. And so a lot of those other things that they don't think about going into it happen to be that financial planning aspect or advocacy on the financial side, because the bootstrapping element to a small business is real. And like you said, they dig into that cookie jar and don't always set up processes that money actually gets paid back. And so if it doesn't, then where's it going? Because it's not going to be benefiting you long term. And so I think a lot of people that are going to be listening to this, it's really going to resonate with them because they probably are thinking, oh boy, they just hit the nail on the head and I don't have those things in place. And so, I probably need to give them a call so I can have someone really not only explain it to me in the way in which you just did, but be able to advocate for you because there's a real deficit for even the smartest of business owners. If you're not a CPA or someone that has financial planning experience, your expertise doesn't lie there. So you really have to outsource that to someone who can support you on those lines. And so I love the way this has already started. I have a feeling you're going to have a lot of great insight here. And we talk a lot in my industry, we're private lenders. And so financial hygiene and the ability to become or to achieve sustainable growth relies on a lot of things. And so within your industry and when you're participating in things with your clients, what are the most common financial hygiene issues that you see when you're first engaging those business owners?
So this might surprise you and your listeners, but I mean, a big issue is just having bookkeeping, frankly, and using quality bookkeeping, whether you're using QuickBooks or Sage, even Excel or numbers or whatever Google's version of spreadsheets. You have to keep your revenues and your expenses tracked. And most business owners, especially when you're new to the game, you're doing it for one reason, but you should be doing it for a different reason. The reason you're doing it is for tax purposes.
Right.
And you can be tax compliant in your accounting, meaning you can hand your books over to your accountant and they know what's deductible and what's income, and they can mash it all together to prepare a return. That's not where you should stop. Your numbers, your income and your expenses of how you're allocating capital, because whether you believe it or not, you are allocating capital just like Warren Buffett is. He deals with more commas in his numbers, but
Right.
and you and I as business owners are dealing with the same concepts.
Mm-hmm.
You need to give you information about your business, not data or just like, hey, I spent $1 on a meal. That's data, but the information that the data comprises. High quality accounting, having attention to detail, whether you're doing it or whether you're outsourcing it, I think is the number one thing that most business owners miss. Because when you get into that jam, and let's say you go to that CPA or you go to a business advisor like me, the very first thing they're going to want to look at to get a lay of the land, they want to hear your story. They want to hear the problem, kind of the narrative. But then they're going to say, well, let me see the numbers.
Right.
Because that's the other side of that's the unspoken side of the story that is very important to a professional to be able to see. And it should be increasingly important to you as the lead investor in your own company to have solid numbers. So that's where I would say it would start.
Again, couldn't agree with you more, especially given the industry that I work within. I think I tell people a lot, there are, and you named so many that I had not even heard of before. There are that many accounting software services that you can use on your computer yourself and make yourself believe that all is well. But there's so many issues that fall into line just right in that approach right there. I always tell people, something like QuickBooks is a data repository, and all it does is take what you give it and spit out, information based off of whatever you give it. So if you're giving it inaccurate information, you're going to get inaccurate information back.
Right.
And when you're taking that, in my industry, you're taking that to your lender, that's showing some real truth that you probably aren't aware of because you allowed it to get to that extent and have it be that's the practice that you have in terms of accounting or bookkeeping for your business.
Yeah.
And so I agree with you. I think, especially when it comes to being able to drive your money, right? You need to know where your money is at all times, going out and coming in, so you know that you're spending within those means, right? I think of things in terms of spending my own money. If I only have a certain amount in my bank account and I spend it all, I'm not going to have any left over afterwards. And if I wasn't tracking it, then that's where the problem lies. It's just a symptom of the problem being that I wasn't accurately gauging how much was coming in and how much was going out. And I think a lot of business owners have that as an issue. And we tell them all the time, one of the first things you need to do when you start your business is have someone handling that for you. Because if it isn't your expertise, you're probably going to make some mistakes. And those mistakes are going to cause, basically a domino effect of other negative things that can happen because you can't keep track. One of which is going to be impeding your ability to get funding for your company to grow and to scale. And so I love that, spotlighted that. I think it's super important.
Yeah, let me add like what I would say the very next thing after that. So let's say you have a system and you're tracking your income and your expenses. As you build up that data, as you put more data into the system to turn into information and think out, especially for people that are listening to this that maybe do a lot of government contracting, is you also need to look at the timing of
Hmm.
when income arrives and when expenses are paid. Most businesses fail because they run out of money, not because they're bad businesses or they're doing the whole of the job. They just literally run out of cash. And a lot of times that's
Hmm.
because the distance between when revenue hits versus when they're paying their bills, they pay their bills either too fast before the next revenue hit comes and they don't have that timing. That's another reason to track those things in a system. We call it cash conversion cycle, meaning you sell something on your government contract. Everyone's excited. We could put revenue on the board, but revenue is not cash.
Right.
We know that as a lender. You definitely know that. I know that as a business advisor. But again, there's no business owner school out there that teaches words of finance are complicated. I think we overcomplicate. Our industry is overcomplicated it, but you have to learn these things. And so you could have made a sale, you have revenue, but then you have payroll, expenses, rent for your office, all kinds of things that don't really care whether the revenue is turned into cash.
Right.
And so understanding your cash conversion cycle can only happen when you have quality bookkeeping. And so these things definitely build on one another, and understanding that cycle on how long it takes for you to get paid. Because sometimes in government contracting, I think you can go for a long period. You won the deal, it's
Hmm.
yours, and you may not get paid for 100 days.
Right.
But it's crazy. Your office staff wants to get a paycheck every 1st and 15th. And you
Right.
could have 6 1st and 15ths between winning the contract and getting paid on the contract. So you got to have an amount of money in the business at all times circulating,
Hmm.
like the blood in your body. In other words,
Hmm.
your heart and your lungs move the blood around. You got to have that. And you have to have enough. If either one of those conditions is not happening in your body, you're in trouble.
Hmm.
Same
Hmm.
thing in your business. You have to have enough cash in the body, working capital, and it has to circulate.
Hmm.
Revenue and expenses. That's what keeps it going. And I love thinking about this stuff and talking about it. Most people don't.
Yeah. It makes them uncomfortable.
Right. But again, that's the difference between the business owning you or you owning your business.
Very true. Very true. And I love that perspective as well, because it's a great segue into what else I was going to ask you in terms of, especially nowadays, and especially within government contracting, when you go through a almost 50-day government shutdown, and then the one that we've had in the last several weeks that's come through, although it's been minimally affecting multiple agencies, like the entire government shutdown prior to, it still is a deficit for businesses that are doing business with the agencies that are being affected. And so, what a lot of businesses have had, proverbial come to Jesus moment where they're like, okay, I got into this business because I love it and I know I can make money doing it, but what's my long-term plan for
Yeah.
this, right? And so, with that being said, and with businesses that are probably may not have a plan in place for something of that nature, of what does your end goal look like and what's the process to put up in front of that. So from a valuation and investment standpoint, what are some key drivers that truly increase a business's long-term value? One of which obviously would be what you're talking about, is keeping that capital, in place, because once that goes, obviously it's going to make the long term turn into a short term business value. But from the perspective of valuation and investment, what are some key drivers there that can help increase the long term value?
Yeah. That's a great question. I think something, and again, I'm going to speak in some generalities here. And so if you start going in specific companies, there's always like reasons that kind of feather out from there. But that in broadly speaking, consistency drives valuation. In other words, if you can demonstrate, again, let's assume you got your bookkeeping in order, you understand your financial reports and what they need, lining up a consistent track record of profitability,
Mhm.
not where, so looking like a seesaw, like ups and downs, but the ups are awesome and the downs are really bad.
Mhm.
Think about that piano lesson. Just set that metronome and it just tick, 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 and it just stays on that constant because think about it. When you're selling that business, most people, so you founded the business, you love the game, you're solving problems, and that's why you did it. We tell our clients the next owner of your business is going to be a professional buyer of businesses. They're probably not going to be in it for the love of the game. They're probably not in it to revolutionize the industry. They are using money to make money. If someone showed you this super risky investment where like, man, when it's awesome, it's awesome. But when it sucks, it's horrible. That's risky. Think about credit scores. You have a low credit score. It means you're less likely to pay the loan back. So the money is going to cost you more. The interest rate goes up. Same thing in a company. Consistent profitability, consistent cash flow, less risk. Higher price because it's more valuable to a financial buyer of a company. You're like, man, we buy this thing. It is like a metronome. Good economy, bad economy, whatever's going on, like they're well run. They may not have the most revenue. They might not have the most profit, but it's consistent. So consistency, I think, is the number one thing that drives valuation.
I love the analogy there. I'm sorry, the metronome. I'm following very easily. Yeah.
Yeah. I mean, if you can metronome your company, that's going to be extremely valuable to someone, even if you're not the biggest or the baddest. Second thing I think that drives valuation in priority is you want to see growth, but what you want to see is, are you growing efficiently? So as revenue climbs, what is overhead in total lockstep with that? Meaning for every $100 in growth, you've got to add $20 in overhead. It's linear. Or are you able to drive efficiency and grow revenue and not grow your overhead as rapidly? So if revenue grows at 10%, do you have to grow revenue at 10% to keep up with it? Can you grow overhead at say 7% while your revenue increases at 10%? Again, you're only going to know that if you've got quality bookkeeping. It always goes back to bookkeeping. It's a do not pass go, do not collect $200 kind of thing. They have to be linked together. But you want to start seeing where, okay, we're getting more efficient in our growth. It's taking less resources from the company, from the business owner's pocket. Did you want to think about it that way? See those gains. So that will be second. Now, that sort of contradicts what I said about consistency, where it's not the same every time.
Right.
But don't take me literally on that. You want to see consistency across time, but people do want to see that you do have the ability to grow.
Right. And with growth sometimes takes some risks. So you might see a dip in the beginning of that risk taking, but when it works out to your favor, the reward is worth the risk that was taken. And so I like the way that you've broken that down.
Yeah, to what you guys are doing. I mean, growth, a lot of times, you talked about bootstrapping earlier. That's the great American dream, is that you just bootstrap your way to billions. Well, that literally never happens. You can bootstrap your way to millions, maybe.
Right.
But if you're going to grow, a lot of times you've got to introduce more capital or different types of capital into your business that do provide sort of a faster burning, hotter burning fuel for you. Because just funding growth out of cash flow, that's one of the things that we're helping our clients decide is, if you have profit in your business, what do you do with it? Do you pay yourself with it? And buy a sailboat, if you will, or pay for college for your kids? Like, what do you do? Do you do that?
Right.
Second, do you reinvest into your business? Add more people, better equipment, better systems? Or three, do you pay down debt? You assume you're paying your debts. What I mean is, like, are you excelling those debt payments or working with a balance sheet? Those are kind of the three basic things that a business owner can do with profit. And that's what we're helping our clients understand. Well, what's the right thing to do now with that profit? That's where we're blending the personal planning and the business planning in there, but also helping them understand the smart use of debt. Some people have these weird, like, oh, I'm never going to use debt, or debt's bad.
Right.
Wrong.
It's a 4-letter word, but not one of the fun ones that I like to use when I'm not on camera.
Yeah, that's a business myth that is hurting, honestly, a lot of businesses out there. And it's because of lack of knowledge. It's a lack of education, literally, on the part of the business owner in terms of what it is, one, and two, what it can do. Most people think about, oh, this is the person that maxes out credit cards or just is a profligate spender or something like that. And I think when you're a business owner, you actually have a better shot at learning how much of a tool and a levering effect that can have versus just kind of the old fashioned way of bootstrapping.
Yeah, and I think the gap between that is having advice from someone who actually knows what that can do for you. And so, you've already touched on what I was going to move into, which is fabulous about business owners needing to think about what is the balance between reinvesting in your company when you do have that extra cash to do so with, or versus taking the distribution, and then also looking at, optimizing, paying down your debt or bringing new debt in so that that growth for those potential, really spark moments for your company can actually take flight. I mean, without that, it usually doesn't happen. And so, what are some recommendations within there with regard to business owners that are facing that now that they've done pretty well? They have a little bit of cash that can be used either in that reinvestment back into the business or potentially paying themselves back for the money that they used that when they were bootstrapping, because it came from somewhere. And most of the time it comes from people's, 401ks from their last job or, equity out of their homes.
Yeah. Well, that my answer to that question is, that's why you hire an advisor to help you look at all those different pieces and also to help get from you, like, what is important and when do these things need to happen? I mean, that really is the answer to what should you do. But a lot of times people do it backwards, where they're like, okay, now I've got the cash. Now what do I do with it? As opposed to kind of thinking in advance. Well, when this happens, in other words, I've planned my business to work this way. There are some things out of my control, but in a lot of ways, there's an inevitability that this is going to happen. So when we get there, we need to kind of have pre-thought, what are we going to do? Sometimes the business owner does need to sort of buttress their balance sheet, pay down debt. That ought to be because they've got growth plans in the future. That means that they need to take on more capital, and so they need to have better borrowing capacity and things like that. Again, they might to help you think about that and kind of pre-plan. Going back to the example we gave about someone who's bootstrapped and they need to replenish retirement funds or things like that. Again, how much do you need and when do you need it? What do you need to be able to retire? And that's what we're helping our clients understand. What does your business need to be worth? I don't care about what it is now. I mean, it has a current value. What does it need to be worth? And when does that need to happen? So if you have a financial advisor, let's say you did take money out of a 401 or a retirement plan, you go to them and say, I know I took $20,000 out 3 years ago. Well, putting $20,000 back now, they're behind because of time value of money. They probably need to put, I'm making up a number here, but like $30,000 back. I think you got to have someone in the corner running those numbers to say, well, really to get back in track, it's not putting it back one for one. You've got to put an additional amount back to kind of make up for that lost time.
Right. And that is a great way to move into. So we have that in place and the succession or exit planning with that in mind. How long are you going to run this business before you're willing to, say, okay, I've done what I need to do. And so I'm going to need to go back to not only living off of what I sell this company for, but also being able to live off of the retirement funds that I've been able to have for myself. So that when does that money need to be put back in there based off of that exit planning? And so knowing that, and understanding, that especially in the way that most people are growing right now, especially in government contracting, is a lot through acquisition. And so business owners that are getting to that point where that exit planning should be attractive because, if they know they've got a buyer's or seller's market, it's best time to go instead of it being a buyer's market when you're not doing well. So what are you seeing that are some of the mistakes that business owners make in the waiting game of thinking about succession or the exit planning strategy? Where do you see some disconnect there for them?
So a lot of them just don't have a plan. I mean, let me say this. It's not a plan when you just say, oh, I'll sell it one day. That's not a plan.
Yeah.
Second behind that is they have, I joke around with our clients saying, like, I really can't stand your friends. And what I mean by this is a lot of people have a friend who's in their industry and they did sell a company. And all they know is what their friend was willing to tell them. And it's kind of like the fish story. Like, the fish was this big. You should have said,
right.
Well, folks, your friend's not telling you the whole story. They're not giving you all the gory details. And as we do when we give these friend stories, you're like, well, my friend's kind of a bozo and I'm doing even better than that. And so I'm going to add this like, imaginary multiple on top of what they got. And so therefore that's what I should get. And there are hundreds of thousands of business owners on the street right now who are having those exact thoughts. And they're going to learn the hard way how wrong they are, because the next owner of your company will be a professional buyer of companies. It is a spreadsheet for them. They don't care about your equipment. They don't care about your whiz-bang employees. They don't care about the money you have in the bank. They don't even really care about the contracts you have, in as much as they care about the consistency. They care about consistent financials, reported financials. They want to see appropriate reinvestment. In other words, if every bit of profit you make, you pull out of the company, that's not going to be a very valuable company. What I hope that business owner is doing is saving half of everything they make and putting it in the bank so that they can retire, because you're treating your company like a bond, not a stock. So bonds don't really appreciate in that. I know interest rates, killing prices, stuff like that, but just forget that per se. Everyone buys stocks because they buy it for $10 one day and they hope to sell it for $1,000 in the future. That's that capital appreciation. That's what your company is. Your company might pay you profits in the form of a dividend. No one owns investments just for the dividend. The dividend is nice to have along the way, but they want the growth in value. And so you have to have a plan for what you need to get from the sale of your business, and you work it backwards from there. We're never going to get away from that concept of beginning with the end in mind. Stephen Covey was absolutely brilliant for putting that down on paper. And it's like a law of physics, if you will, for a time. Like, you cannot get away from it. You might not like it, but it's a law. So you start with what you know you're going to need, and you work backwards from there to see where you are. And you work with trying to drive valuation in a demonstrable and documented way, so that when you hit that target and the buyers come looking, they're going to see the same thing that you see. Do not base your exit plan on what happened to your friend.
Right. I mean, that's great advice. And I have about 20 other questions that I wanted to ask you today. But the good news is everything that you said resonated to me. And I am not someone with a financial background. And so I know that people that are listening to this conversation have been able to follow you equally as well as I was able to. So I think the best part about this is, unfortunately, we're going to have to wrap it up. But the good news is I definitely want to have you back on.
Yeah, let's do it.
Because I love the way that you've I think that we definitely have more that we need to cover because, like I said, I have information on my list right now that I didn't even get a chance to get to because I loved in the direction that you were going and the way that you were talking about it, because I know it's going to resonate with people that are listening today. So I really appreciate your time, but I hope you will come back and be a guest again soon.
Happy to do it. I love talking about this stuff, and I love kind of demystifying it for people, because it really shouldn't be as hard as we make it out to be. I've built our firm on just that, and I get a big kick out of it. So I'd love to come back. Let's do a part 2 and keep going through these questions. It was fun.
I love it. Thank you so much for that. And I encourage everyone to reach out to John and his team on LinkedIn, and encourage you to get some consultation there and potentially join a partnership with him, because if you liked what you heard today, he'll definitely be able to help you do better in the areas in your work that you might not be an expert in. So thank you again for your time, and thank you all for joining us today. As always, we pride ourselves on sharing the most insightful and exciting people and information to help you better navigate your GovCon journey. If you like what you heard today, you can see all of our past podcasts, which are archived on our Parabolis YouTube channel. Stay tuned for all of our future guests in the coming months as we help you grow to great heights in the year ahead. I'm Teresa Moon, and this is Spilling the Tea on GovCon. Have a great day, my friends.